Hello, Matthew Bell with insuranceprescription.com. Today I wanted to pick up on a conversational strand that I started in a different video. In that video, I went through the 4 pay modes that are available for life insurance premiums. The pay mode is just the frequency with which you're going to be paying your life insurance premium. So you can pay it once a year, that would be annually. You can pay it twice a year, semi-annually, 4 times a year, quarterly, or you could pay it monthly, which obviously would involve paying 12 times a year. Now, in passing in that video, I mentioned the fact that the more frequently you pay, the more expensive it tends to be. Now, there's a big asterisk on that. It's not always that way, but generally, the more times you pay, the more you are going to pay. And there's 2 reasons for that. The first reason is that there's a higher expense loading. The more checks you write or the more EFT drafts that are generated, the more attention has to be paid to your account, essentially. People are going to have to be hired to touch the account more frequently, look at it more frequently, going to have to be maintained more frequently, essentially. But the second reason has to do with the interest crediting factor. It's going to have to do with the fact that an annual payment is going to accrue interest more quickly than some other premium mode that's going to require more payments. So in other words, if you can pay it in one amount upfront, it's going to build interest more quickly, and it's going to help to keep the price down. Now, I personally thought that's an interesting enough idea that it's worth looking at in a little more detail, and that's what I want to do here. So the question is, why does it frequently cost more to pay your life insurance premiums monthly than it does to pay them annually? Consider that there is an asterisk on that because it is not always the case. So consult your agent, see your illustration, look at your policy, contact your insurance company. I mean, there's going to be any number of factors here, but you can even substitute, why does it cost more to pay it semi-annually than annually? Why does it cost more to pay it quarterly than semi-annually? I mean, this in general is going to be the case, that the more payments you make, the higher the cost is going to be. Now, here's what I said in the previous video.
The second reason that annual payments are generally a little less expensive is got to do with the interest crediting factor. And this is the fact that if you pay a single larger amount to an insurance company up front, then they're going to be able to invest that amount and generate a certain rate of return. On the other hand, if you pay the same amount in terms of insurance cost over the course of 12 months, then even though from an expense standpoint, from a mortality standpoint, you might pay in the exact same amount, the fact of the matter is the insurance company is going to make a little less interest because the first payment that they get is going to be in month 1, the second payment is going to be in month 2, the third in month 3, and so the interest on the first payment is going to start on month 1, but the interest on the last payment is only going to have 1 month to go before the end of the year. In general, what happens is if you elect a payment option, like monthly payment, that is going to implicate you in paying installments, then the insurance company generally tacks on just a little bit of extra money each month to account for the interest that they lose by not having had your entire annual payment all up front at the same time.
So remember, this is only one of 2 considerations. The second is the expense loading. I'm not really going to get into that here. Here we're just going to get into the question of why, from an interest point of view, does it make a difference how many checks you write or how many EFT drafts are made. So here's a simple example. Now please remember that this example is abstracting away from a lot of information and it's very crude. So think of this as just a toy model. The numbers are going to be extraordinarily rough. I'm not an actuary. On top of all the other things I'm not a financial advisor. I'm not a tax preparer. I'm not a mathematician. So this is simply a rough illustration, a rough idea of how this works. But in general, gross premium is going to be made up of 3 different things: the mortality charge, an expense charge, and then offsetting interest. So you can see in general your mortality charge and your expense charge are going to be added together, and then the offsetting interest is going to be subtracted. So think of a rough example. Now obviously I have purposely contrived the example just to make the numbers easy and work out. But let's suppose you have a $1,200 mortality charge. And that means whatever your age, whatever the underwriting is, whatever the policy death benefit is for your policy, in this case, your premium is $1,200 annualized. And let's suppose that your expense charges add up to $36.46. Well, that means those two added together, just the mortality and the expenses, is going to be $1,236.46. Now, if we just divide that number by 12, we could say, well, this is the amount of premium that you're going to owe then, your mortality charge plus your expense charge. And if you want to pay it monthly, we'll just divide it by 12, and we get $103.04, roughly speaking. But remember that the insurance company doesn't just take the premium payment and put it into a tin can. It's going to have your premium dollars are going to be invested in various different instruments. Now, there are laws constraining what kinds of instruments the insurance company can utilize, and this is not a video getting into that. But let's just suppose a very conservative 3% rate of return, and we notice that $1,200 invested at a very conservative 3% is going to generate about $36 a year. Well, then we can assume that that $36 a year is going to be enough to offset the expense charge. In this case, it's not always obviously going to offset the expense charge 100%. My example, once again, is very rough. It's very contrived, but this is just in general the way it works. When you add up the mortality and the expenses, you get a premium amount. When you remember that a certain amount of money invested at interest is going to generate a return, you can actually subtract that expected return and keep the cost down just a little bit. So the toy example, you can see the assumptions here. Mortality charge of $1,200, the expense charge of $36.46, and then the annual interest of $36.46, which is 3% on $1,200. However, what it is it's actually $1,200 assumed to be paid in one installment, one payment. So consider, just to see how this actually works out, consider two different scenarios right from the beginning. On scenario one, you're going to pay it annually. So you're just going to write one check to the insurance company for $1,200, one installment. So you see, I have 12 different slots there. And you can see $1,200 paid in month one, whatever month that is. And then you can see for the next 11 months, nothing else is owed. You've already paid your premium. I'm assuming a 3% annual rate of return, and you can see that it's compounded every month. So you get $3 of interest the first month, $3.01 the second month, $3.02, and so on down the line. And so by the end of the year, that account has accumulated $1,236.46. Now contrast that with scenario number two, which is a scenario where you pay monthly instead. So here, the $1,200 is not paid all at once. Rather, it's paid in 12 installments of $100 each. So you can see that's the same $1,200 in principle, the same mortality charge, $1,200 in both cases. We haven't, your underwriting hasn't been changed, your life expectancy hasn't changed, $1,200 in both cases, but the difference is the rate at which you're paying the premium. So you see that there's a 3% rate of return that's assumed in both cases. That's not changed. The only thing that's changed is that you're paying, in scenario two, 12 payments of $100 instead of one payment of $1,200. And what happens is you don't see the interest build up as quickly. Whereas you see $3 of interest every month when you pay the $1,200 in one payment. In scenario two, month number one, you only have a quarter. Month two, you have another $100, so you have another quarter. Month three, you have another quarter, and so on. And so what you have to do is build up to $3, and so that affects the total. After the end of the year, on scenario two, you only have $1,219.68. Now the difference between $1,236.46 and $1,219.68 is $16.78. Now if we divide that number by 12, we end up with a difference per month of about $1.40. Remember, please, that these are only rough numbers. I'm not an actuary. I'm sure there are actuaries rolling their eyes or, worse, laughing at the crudity of my example, but I think the scenario, rough as it is enough to give you a fix on the difference. When you put the money in more slowly, let's say $100 a month over 12 months in my example, the interest also builds more slowly and you end up with a shortfall, at least compared to what you would have if you had to put the $1,200 in all at one time. Now then the question is, what is to be done about that difference? Does the insurance company simply eat the difference? Does it eat that cost, or does it translate it to you? And the answer is it's going to translate to you. So that difference of $1.40 a month, you can see looking at scenario three, which is an adjusted monthly pay mode. So now instead of paying $100 a month, we're going to add $1.40 on every single month. So now you see $1,200 paid in 12 installments, but it's no longer $1,200 right on the nose. Rather, it's going to be $1,216 and some change, which is going to be the total with the interest difference built onto it. And since you're paying it monthly, we're going to distribute that difference over the course of 12 months, bringing the payment to around $101.40. Now you see what happens is with $101.40 in place every month, the interest accumulates still slowly, but it builds to a point that's roughly comparable to the amount we had if you paid the $1,200 all at one go. Now, once again, the numbers are crude. This is just for illustration, so I see that they don't match to the penny, but in general, this is the reason why the amount that you pay is more expensive for a monthly premium than it would be for an annual. Again, these are just approximations. So you can see scenario 1, the annual premium, $1,200 if you pay it at one payment, versus scenario 2, $1,216.80 if you pay it over the course of the year in 12 installments. And the installments that you pay are not $100, they're $101.40. So you can see in scenario 1, $1,200 literally is $1,200 even because it's able to build to $1,236.46. And in scenario number 3, which is our adjusted monthly total, you actually are paying $101.40. And so the point is, if you look at those totals, you're going to end up paying slightly more in scenario 3. And the reason for that is they're counting on $36 in addition to the mortality charge. So they're counting on an additional $36. And in scenario 1, that $36 comes from the interest because you pay one installment and that installment is sufficient to generate the required interest. In scenario 2, paying it over the course of 12 months, $1,200 is no longer sufficient to build to the required amount of $1,236. And therefore, you have to kick in an additional $16 and some change, which means your monthly premium goes from $100 to $101.40. And remember, finally, that this was the number rundown. So the mortality charge was $1,200. The expense charge is $36.46. And so that's the amount the insurance company is requiring. If we can build that amount simply with interest, as we can in the case where a person puts $1,200 in at one go, then you don't owe anything additional. But in a case where you're going to put the money in, you're going to put the mortality amount in over the course of the year, the interest is going to build more slowly. And in our example, it's not enough. And therefore, you have to actually kick in a little bit more. So this is one of the reasons why a monthly amount is generally more expensive, or even again, in cases where that doesn't turn out to be the case, and there can be additional factors. For example, let's say that the insurance company has some way to keep the expense charge down. You might find there are counterexamples to this, but in general, annual is going to be the least expensive, semi-annual next, quarterly next, and monthly is often the most expensive option. And again, part of the reason for that is the way in which the interest builds. So if you found something of use in this video, please like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.